Hello, everyone. Welcome to the Fuqua LinkedIn Live. I'm Campbell Harvey, Professor of Finance at Duke University. And today we're going to talk about the election. You're probably electioned out in terms of all the pundits talking about the implications. I think that in a way, everybody's got like an agenda. So let me put my kind of personal biases on the table. I did not vote in the US election because I can't vote. So I'm a Canadian citizen, not a US citizen. And this is actually interesting for me because I basically have skin in the game indirectly. I'm a guest in the US, but it allows me to basically comment on political events, not really being like a member of any US political party. So that's kind of where I come from. And I study business cycles, as you know from previous LinkedIn, my research on inverted yield curves and economic activity. And I also focus on investment. So in terms of my teaching, traditionally I've taught an advanced investment course. Many of you took this course. And part of that course is to kind of figure out the appropriate trade-offs between risk and return. And indeed, what is risk? So what we've seen usually, an election happens and there is a winner and a loser. And there's a resolution of uncertainty. So even if there's a 90% chance that somebody's going to win, and then they do win, there is a resolution of uncertainty that's important. So in our particular situation, we don't have a winner right now. But the US election is not a simple election like a parliamentary election in the UK or Canada, where if you win a majority of seats, then you are, the prime minister is elected from the party. Obviously, the US is a more complex system where you've got a House, a Senate, and the executive branch. So what do we know, given that this election at the presidential level is not settled? And what are the implications for the economy and financial markets? So let's kind of start with what we know. The first thing is something that we should have known for a long time, and that is that the polling is not accurate. So I thought we learned this lesson in 2016. I got an email yesterday morning from an old friend who reminded me of a conversation just before the US election in 2016, where it looked like Hillary Clinton was going to walk away with the presidency. And he reminded me of what I said. And what I talked about was the so-called Bradley effect. I said, don't believe the polls because of the Bradley effect. And what that means in our particular situation in 2016 was that given the, some of the behaviors of President Trump, many people were uncomfortable saying that they support him. And this definitely came into play in 2016. So in conversations with people, or if you're on the phone with the pollster, you'll say you're voting Democrat. But when you get to the actual polling booth or mail your ballot in, it's a different story. And the Bradley effect played out very powerfully in 2016. And I believe it played out in 2020 also. So the gap is a striking gap between the latest polls just before the election, which essentially gave Biden a double-digit lead, and what actually happened. So while polls are not that useful, in my opinion, there are other mechanisms that I think are superior. So the prediction markets, very effective. So much more effective than the polling. And we could see that play last night. For example, if you look at PredictIt, so all one word, .org, is probably the most developed prediction market. And they were saying that Trump was going to carry Florida. And that's exactly what happened. And various other predictions suggest that they're much closer. So where are we right now? So if you look at predictit.org, you'll see that Joe Biden has an 80% probability of becoming a president. So that's basically the way it works. There's high probability, in my opinion, that even though this election is not going to be resolved officially for a number of days, that we'll see a change in the presidency. So what does that mean in terms of the markets? Well, it turns out that the key thing for kind of the economic and financial implications was not the presidency, but the Senate. So this idea of having one party, whether it's Republican or Democrat, having the House, the Senate, and the executive branch, that potentially introduces risk. So one party gets their way. It is clear that this is not going to happen this time around. So it looks like the Senate will be maintained by the Republicans, and it looks like the executive branch will go to the Democrats, but in a way it doesn't matter because the House will remain a Democrat. So essentially, we've got a split system, which means that there can't be these bold actions that if one party has got control of all three, that they could actually pull off. So I'm making kind of a subtle argument here in terms of the resolution of uncertainty. And this has to do with if there is some division within the House, the Senate, or executive branch, then it just makes it more difficult to do something that might be viewed as more extreme. Okay, and again, this is not a political statement whatsoever. I'm purely talking about uncertainty. So uncertainty is not a good thing. Uncertainty causes, it's a type of risk. And when you're faced with this type of risk, often the optimal situation for managers, corporate leaders, is to wait. So if there's a lot of uncertainty, you delay that hiring. You delay that capital investment, that project that you want to build. And that tends to slow economic activity. So it is a good thing to resolve the uncertainty, and an important part of that uncertainty effectively has been resolved. So it is extremely unlikely that we will see a situation where one party controls all three. Okay, so that has been resolved. Now let's talk about the sort of financial implications and the economic implications. So I've got a few graphs that I would like to share and maybe talk through that. And I'm going to share not in presentation mode, but just so you can see this. And hopefully you can see this. economic implications of the US election. And let me just show you a few slides. And this is a key slide. So this is the US 10-year Treasury yield. And the action that we've seen after the election is in multiple dimensions, but I think this is the most important dimension, that yield dropped very substantially once it was clear that, that the Republicans were going to retain control of the Senate. It's also the case that the stock market has gone up. So indeed, it's kind of interesting to look at the stock market. That looks like the V-shaped recovery that I've talked about previously. I think it's probably far too optimistic, but nevertheless, this is where we are. And the stock market is up sharply today. So the question is why? And I believe there are two reasons. So the number one reason I've already talked about, that there is a resolution of uncertainty, even though it seems maybe a little counterintuitive because we don't know who the president will be. But that is actually only part of the uncertainty. So the resolution of uncertainty I'm talking about is the fact that one party will not control all three parts of the government. Okay, so that's one factor. The more important factor is the basic difference between the Democratic platform and the Republican platform. So the difference is that the Democrats wanted to be far more aggressive on spending, fiscal spending. The Republicans, while there's been considerable spending in terms of triage for the economy during the COVID-19 crisis, it is clear right now that the Republicans are hesitant to continue with the degree of fiscal support for the economy. That is the key difference. And why would the yield go down? Okay, so basically what we've seen over the last number of months is that inflation expectations have been going up. And we've seen the yields go up with those inflation expectations. And why would the inflation expectations be going up? Well, they're going up because of the following mechanism. That people in the market see the sort of fiscal plans for spending, and when they see that, they figure that's going to have to be paid for some way. And one way to actually do that is through inflation. It's also the case that the Democrats were much more aggressive on taxation, so increased taxation. So there's some benefit in terms of the stock market for that also. So I think that it's fairly clear that that at this point, where you've got the Senate actually being controlled by Republicans, that it will be extremely unlikely that some of that fiscal policy can be pushed through. And as a result, this, I think, tempers the inflation expectations and leads to the yields to actually decrease. Okay, so there's a third aspect that is even less obvious, and that is, it's somewhat related to my first point. But when you've got a split government, the government just isn't able to do a lot. There's a lot of negotiation, but often it goes nowhere. And given the election cycle in the US is every 2 years for the House, it's really difficult to take that long-term perspective. And indeed, I think that markets sometimes reward that. It's better to do nothing than to do something that might be damaging. And I do think that markets are somewhat concerned about the growth rate of the US economy going forward. We've seen growth continually decrease. We've seen innovation, where the US is kind of the leader in innovation traditionally. Well, we're seeing a lot of action elsewhere in the world. And you can look to China, you can look to parts of Europe also. The US might be losing that edge. And when you lose that edge, you lose your growth. Okay, so there's a lot of stuff actually going on here. What has happened to the markets is not really surprising to me. There's one thing that maybe is a little bit surprising to me, and that is a topic that I've talked to you before about, and that's what's happened to the price of gold. So the price of gold is actually decreased. So I'm not, that usually it goes the other way with rates especially. But again, I think that what a lot of people are doing is liquidating gold and buying equities.